Good evening, everybody. Welcome to Zoom at 8. My name is Julianne Peterson, and I am your host every Tuesday night for Zoom at 8. As well, I am a loan officer, senior director at Old Capital Lending. You know, we've been closing loans for 38 years. That is a long time. We are specialists in multifamily, although we'll do all the other asset classes. And BTR, by the way, build to rent, is one of those that are really starting to show its face. Like, where can we go to do something similar to multifamily? And BTR is a great asset class that we're doing some ground up construction. So anyway, I'm excited that you're here tonight. You know, Old Capital can close your next loan. So if you're looking at something and you'd like to know how much is the bank going to bring me, I can provide you a quote, and that would require a T12, a rent roll, an offering memorandum, and your underwriting. And you want to do that at least 2 days before you put in an LOI. Don't go into this thinking, oh, I don't need to check in with the bank, because as you know, your lender is your biggest partner. So you need to make sure that whatever I can bring makes sense for your investor returns, right? So that's how the lender gets involved. We want to understand the deal. Every deal is different. So when you see some of these banks will put out a quote sheet, that quote sheet is as good as the minute it was printed. So jump in and let's have a conversation. You need to know who's on your team, where the net worth, where the liquidity is coming from. Because to qualify, we need to have experience, net worth, and liquidity on the team. So tonight, we are going to have our live conversation with Aimee Morgan Nicotra. She is a special friend and been here a couple times to Zoom at 8, and we're excited to hear what's been happening in the appraisal world in multifamily. So we'll be over to share. She'll be over here to share her information here shortly. So the guidelines changed, everybody. If you are single family driven, or at least you have been in the past, and you own 10 doors, 10 single family doors. Now, single family, which is considered residential, is a 1 to 4 units. So if you own 10 doors, and now I keep saying that, but it could be 4 units. You could have 2 4 units and 2 and 1 duplex. That's 10. Okay. You can be a sponsor. You can buy these deals by yourself. Okay. So if you don't have the money and you don't have the single family experience, go find somebody that does, and they can be a sponsor on your deal. Very, very new guidelines, over a year old, but a lot of people don't realize that. We used to say, go get lost. You can't play in this. Now you can. Okay. All right. I think that's everybody who's new here. So we will now spend all of the rest of our time in great conversation with our good friend, Aimee Morgan. Aimee Morgan just got married a year ago. Aimee Nicotra is in the house, and she's been here in the past, like I mentioned earlier. She worked in a couple different companies, CBRE for 10 years. She worked for JLL for 3, and now she's over at Colliers. So these are very large DUS lenders and brokerage firms. And Aimee is a managing director in the Houston office for Colliers Valuation and Advisory Services, and leads the South Central multifamily team. She has extensive experience in the appraisal of multifamily assets with 15 years of experience in this property type. So she knows her information very well and is here to share it with you. She has overseen the completion of thousands of appraisals in the South Central and other markets. Her deep experience includes specialization in agency lending, balance sheet lending, affordable housing, that's your LIHTC and your HAP contracts, proposed developments, new construction lending, BTR developments, commercial to apartment conversions, tax credits and historic conversions, and many other facets of the multifamily space. Aimee's real specialty and passion is client service and ensuring an exceptional client experience on every assignment. So I'm excited to reintroduce you if you've been here in the past, but if you're new to Zoom at 8, you are up for a great evening of education and unveiling what is going on in multifamily. So welcome aboard, Aimee. Great to see you tonight.
Thanks. Happy to be here. All right, without further ado, 10 changes in the multifamily industry that are impacting your valuations. Um, First and foremost, the fundamentals. So the fundamentals remain really strong. And when I say fundamentals, what I mean is supply, demand factors, population growth, employment, all of the things that we want to see be really healthy for multifamily to continue to perform really well. So the fundamentals have stayed really strong. I don't think it's any surprise probably to most of you here who are active investors and active market participants that we've seen some value declines over the past year and a half. But we're really not seeing those value declines due to fundamentals. The value declines we're seeing are coming from the change in the capital markets and the change in the cost of capital. The fundamentals remain really strong, really healthy supply, demand. While rent growth remains very strong and occupancies remain strong in most markets as well. While we have seen an influx of new supply in a lot of the major markets, and I know a lot of you mentioned DFW, being located in DFW, lots of activity there in Houston. I worked about 12 years in DFW before relocating to Houston, so I know the market well. And a perfect example of a market where we've seen a lot of influx of new supply, but really healthy absorption. In fact, this past quarter in DFW saw record absorption over for the past 10 years, despite this influx of new supply. So there still remains a lot of really healthy household demand for housing units. And honestly, I don't think that we're going to see that change anytime soon. I mean, unless we were to go into a really major recession, and when that happens, we see households combine, people move in with parents, households combine, to save money, things like that. But I don't think anyone thinks that that's on the horizon. The jobs reports have remained really, really strong, despite all of the uptake in interest rates. The fundamentals remain really strong. I'm going to talk a little bit more about new product, absorption and things like that in some of these other items. But just the high point there, I think, would be that strong absorption despite the influx of new supply and opportunity in the future because over the past year and a half, with interest rates higher and a lot of market participants sitting on the sidelines, new starts have dramatically slowed. And so what's going to happen, and we haven't seen it yet because there still was a lot of product that was under construction. They'd gotten their financing before rates went up. It was still under construction, still delivering over the past year and a half. But what's about to start happening over the next probably 6 to 8 months is that we're going to start seeing a taper off in that new supply that's hitting each market. And what's going to happen is we're going to have a little gap in new deliveries in most major markets for probably a year to 2 years. And that's going to create some really great rent growth because I don't think we're seeing any slow in the population growth. We're seeing consistent population growth and in-migration remains strong, especially in those markets that are like the Texas markets, Florida markets, Midwest markets all remain very strong in terms of in-migration as well.
Perfect. Thank you.
Yeah. Okay. So agency changes. There have been a few changes happening at the agencies. For one, there's been a lot of turnover at the agencies, and some of that has been on the appraisal side. For example, Freddie Mac has a new chief appraiser, and that's resulted in a lot of new appraisal guidelines and things that are being put out by Freddie Mac. And are changing the appraisal and the underwriting space. There was also a lot of change in leadership in the underwriters, lots of turnover. A few major players at the agencies left, and they joined places like CBRE, JLL, Colliers, all the places I've been. And so what happened is new people have taken over those positions at both Fannie and Freddie. And so it's been an interesting time as they are settling into these roles and kind of getting their bearings. Things are, they're making a little bit different decisions than some of the people that had been there in the past. So it's just been it's been an adjustment, I think, for everyone that's used to agency lending, just because there's been changes. Freddie Mac is also doing a review of their acceptable vendors. So with that new chief appraiser came another internal committee that's currently reviewing all of their vendors and ensuring that they're using the highest quality appraisers. Especially, in this kind of a little bit more challenging time in terms of, leverage, getting deals done, and seeing some distress deals, which we'll get into in a little bit. But that kind of covers the agency changes. Again, kind of the theme is new faces and, new people do things differently. So it's been an adjustment.
So Aimee,
Yeah.
do these? Let me back up. Lucia wants to know: do these changes apply to both single family and multifamily?
Yes. Most of these changes happen on the multifamily side. The single family side, I believe, has remained relatively steady. All the people I know of that left were on the multifamily side. And that is a big side of their business. And again, their chief appraiser he's overall appraisal, but he's particularly focused on the commercial side, meaning the multifamily side. So most of the major changes we've seen have been on the multi side. Yeah. So, and actually, since we're talking agency changes, there's a new emerging program at Freddie. I've seen a lot of great success with it. It is a program that they call their workforce housing program, but it essentially allows you to voluntarily set aside units at maximum AMIs, which it means area median incomes. These are the kind of income restrictions you would typically see at LIHTC properties. But if you have a property that is already naturally affordable, this could be a really great lending option for you. Julie and her team will, be able to guide you through this. But typically what you do is you set aside some units that are already naturally affordable. You agree with Freddie Mac to keep those units affordable for the entire term of the loan. This agreement is only loan driven. It's not a deed restriction. It's not an actual affordable program. There's no tax credits associated with it. But what it does come with is some, favorable rates, a little bit more favorable terms, and some other things that can make what might otherwise not be a deal that pencils work. So definitely something to look into. We've seen great success, and it typically has no impact on your value. So it's not, I have not seen a single one of these where the value has been impacted and therefore impacted your your leverage. So something to look into. All right. So property conditions. As we go into this environment where the cost of capital is higher, We saw a lot of properties acquired in 2020, 21, 22 with value add business plans. And what has happened is a lot of owners have run into business plan challenges, and for various reasons have gotten tight on capital. And so we're seeing more deals with large deferred maintenance items, um, you know, roofs that aren't functional, parking lots that need to be redone, HVACs that are going out, exterior paint that needs to be done, electrical that needs to be either pigtailed or updated or cured in some way. So that is something that the agencies are really paying close attention to. When they are looking to finance a deal, they want to see a deal that looks really clean or has a business plan that's going to include addressing all of those deferred maintenance items. And something to think about, as you are buying and selling, if you're a seller, having that property as clean as possible when you go to market, is going to behoove you given this kind of extra, uh, attention that is going to property conditions. And if you're a buyer, either having a good plan or looking for really clean properties that don't have major deferred maintenance items, you're going to have a lot more success on the agency side. If you've got great property condition. If you don't, there's still a lot of great balance sheet options and other options out there that allow you to have some good bridge financing to get the property where you want it and then go back and get your agency financing. So, and Julie will be the expert on all of those options. All right, and then cap rates. So probably no mystery to anyone in this group, but we've seen massive increases in cap rates since 2022. And I would say what we are in what I would call a period of price discovery. And what I mean by that is values have changed dramatically given what's happened in the capital markets, the cost of capital, which has then had an impact on cap rates. But we have not seen very many trades since all of these changes occurred. So, since we have very limited data, that's why I say we're in this period of price discovery. Every new transaction that we see is telling us something new about the market that we didn't know. Back in 2022, we were sitting in a time where we had oodles of transactions to look at. Everyone had a very clear idea of what an appropriate cap rate was on any given asset. There were dozens of comparables and sales to point to extract that kind of information from. Now you might only have two or three, and the sales that you do have might have been distressed. They may have had atypical motivations. Given how quiet we saw it get in 2023, a lot of people that were selling because they had some atypical motivation to sell. A lot of owners had sort of battened down the hatches and were, waiting to kind of work through this increased interest rate environment and figure out what to do next once we got through. So a lot of people that were selling, they aren't great reads on what market value is. So that said, I would say cap rates are kind of level as of today. Luckily, the Fed has kind of kept things steady for a little bit of time now. And for that reason, we're seeing a lot of return to market, which is great. Good news for everyone, especially you guys that are looking to be, investing, buying, selling. We're finally seeing that pick back up, but cap rates have pretty much held steady, as have interest rates. So that's kind of what we're seeing in terms of cap rates. I'll pause just to make sure there aren't any questions before I launch into our next one.
No, I think what I would just add to that is as you and I had spoken, and my experience, let's just say in Houston with our properties there, is it's really hard to figure out what the value is from a broker standpoint, from a sales standpoint, from a appraisal standpoint. I think that's one of your biggest challenges as an appraiser is trying to figure out the pieces that are not there, that have not been there for, let's say, even as 18 months to 2 years. So how are you finding that in terms of returning an and do we call it an accurate appraisal, or it's really just your thoughts on it, how you see it, because every appraiser could see it differently. I think that's a challenge.
Right. And it's interesting that you use that term accurate. So appraisals are estimates at the end of the day. And so we can't certify that appraisals are accurate, but what we can do is we can make sure that they're credible. And that is the key word for us as appraisers, is to make sure that we have enough information, enough data to provide a credible conclusion. And what that means is that we have to track every sale in the market. We spend a lot of our time talking with brokers, talking with market participants. That means buyers, sellers, brokers, developers, anybody that's in the market and making market decisions. We're staying really in touch with those folks to understand where we're at in the market.
Let's ask what Lucia's question is for DFW. Would
Yeah.
you agree that cap rates today range from 5.1 for luxury class A to 6.65 for something a little bit less, quality?
Yeah, no, I would agree with that for DFW Metro. I think the lowest cap rate I'm seeing on the highest end product would be around a 5. And that would be on pro forma. So income trended forward for year one, but taxes adjusted. Although with our preliminary assessments out, likely that means probably whatever the preliminary assessment is what we're using for taxes. So I always like to qualify when we talk cap rate, are we talking on actuals? Are we talking on pro forma? There's a difference there. And even then there's different methodologies for pro forma. So, but yeah, I would say that's a very accurate range. And that's pretty similar for the other major Texas metros. Again, kind of start around a 5 to a 5.25, and kind of range up to 6.5. And then when you go into tertiary Texas markets, up from there.
So let's just real quickly dig into your statement, which is pro forma. And when we talk about pro forma on agency, how does the appraiser look at pro forma on agency lending?
Yeah, so typically we would look at rental trends, and typically we look at a T12 and a T3. We like to see pro forma EGI about 3% above T12 or T3 EGI. We look closer at a trailing 3 or trailing 1 if you're, for example, an asset that's recently undergone a renovation, and so you're experiencing rapid rent increases due to renovations or some factor like that, or you've been in an asset that's been in lease up. So if there's been rapid changes, we would look closer at a T3 or T1. But for a stable asset, we'd look at T12. So EGI about 3% above the trailing. And then expenses were typically pretty similar to T12 expenses, with adjustments to taxes. Should there be an appropriate adjustment upon sale. And then certainly replacement reserves in there as well.
Now, do you also look at the utilities, doing a trending utilities up 3% or not?
Yes, we do typically trend the utilities up a little bit. It's not necessarily 3%. And if there's a good stable track record on utilities, we might be right on top of the T12. But that is typically what the agencies like to see. And so, especially if we're doing an appraisal for an agency, we often very much mirror, some of the things that they like to see in their underwriting in our
Perfect.
performance.
Great.
Yeah.
Okay, keep going.
Okay.
So we don't lose you again.
Okay. Sorry, you guys.
It's okay.
Okay, so expenses. It's a great segue into expenses. So I'm definitely seeing some trends there. Payroll has been rapidly rising in most major markets. It's no secret that we're facing some inflation. And so that has brought around some wage increases to keep up with inflation. So payroll is rising at most properties, which of course is a challenge, especially as we go into a higher cost of capital environment. Same thing with taxes. We've seen taxes increasing in lots of major metros, especially the Texas markets. And insurance, especially in Texas, Florida, California, coastal markets, the Carolinas as well. We've seen big increases in insurance. And when I got to spend some time last October at Freddie Mac, and this was one of the biggest things that they were talking about as a major trend on their side. And one of their insurance experts was saying that in some of these weather-driven markets, they're seeing 2 to 3 times increases in insurance premiums for the same or less coverage. So lots of headwinds on insurance. There was some talk over the last several months about some softening in insurance premiums, especially in Texas. Although, after all the storms we've just had in both DFW and Houston, who knows if that's really coming. So, insurance and taxes are kind of one of those things that they are what they are. I would say if you're in an area that has, an appeal-driven tax process, for example, Texas, appealing your taxes every year and having a great property tax expert is one of the best ways that you can maintain property value. And so I highly recommend, if you don't have a great property tax expert, I'd be happy to refer you to one. And I'm sure Julie has a bunch in her Rolodex as well, who would be fantastic resources for you. So yeah.
We need to get them here. I just made a note. We'll try and get a tax appealing attorney to come in and we can talk about that.
Yeah, that would be great. It's appeal season too right now, so
So
it's that time of the year.
when you look at advising people on their taxes, now Texas taxes are high and they're not, it's a non-disclosure state. So how do you recommend people, and it's probably per county, but how would somebody look at Dallas versus Austin versus San Antonio and Houston in this
Sure,
market?
yeah.
Yeah.
We've got really the best place to start in Texas right now is with your preliminary 2024 assessment. Um, since most properties are go through the appeal process, the preliminary 2024 assessment in theory should be a little bit higher than what the actual 24 assessment is going to be, unless you got really lucky and there was no increase in your assessment. But that's a great place to start. We're seeing a lot of properties, given the value declines we've had over the past year and a half, we're seeing a lot of properties that are assessed at greater than what they are worth today. So if you are trying to underwrite your taxes, a really safe way to do that, if you've got an assessment that's already above what you think your purchase price should be or is going to be, would be to just mark that assessment down to your purchase price. The you always have the default option of, going to the assessors, showing them your closing statement and saying, this is what I bought the property for. We need to mark the assessment down to this purchase price. In Texas, that's not ideal. We like to see assessments that are below market value, but that's always a last resort is to take them to your closing statement. So if you're above 100% of your value or purchase price, mark down to 100%. If your preliminary 24 is somewhere generally kind of in the 60 to 70% or higher of purchase price, then sticking with your preliminary 2024 assessment and applying last year's tax rates is a really safe way to go. If you're less than about 60% or so of your market value or purchase price on assessment, then you may need to consider an adjustment to taxes on pro forma to account for potential future increases in taxes going forward. If you run into that issue on a deal that you're looking at, please feel free to reach out to Julie or reach out to me or reach out to your tax expert. That's a great way to get some good feedback on where taxes would typically be underwritten. The tax experts are really helpful in helping you understand where you might realistically appeal to. But talking to Julie or someone like me, an appraiser in the market, they're going to give you a better idea of what will the lenders underwrite to, and that's going to impact your financing.
Great. Excellent. Thank you for that.
Gladly. Okay. So next, interest rates. Of course, interest rates have gone up. We're not really seeing any signs that there's going to be a lot of movement going forward. It's had a huge impact on cost of capital, of course, and therefore values. But that said, I think that there is some value in having some stability. We have seen stability for about the past 9 months. The last Fed meeting held rates, pretty steady. And so with that stability, we're starting to see a return to market from a lot of players that have been on the sidelines for a very long time. In March, we saw a massive uptick in transaction activity, which has been really great to see. Nice to see people returning to market and coming out of hiding, if you will. But I don't think that anyone really anticipates that rates are going to change dramatically over the next year. I think we're all hopeful that we'll see some decreases maybe towards the end of the year or early next year, but I don't think anybody thinks that those are going to be dramatic decreases. So I would say, it's pretty safe if you're someone that's been on the sidelines to start coming back to market and adjusting to the new norm. And I think the theme of the next couple of years is going to be adjusting to the new norm. So yeah, Julie would be kind of really the expert on interest rates and where they're going. But does that kind of jive with what you're seeing and hearing as well, Julie?
Yeah, listen, last week the rates dropped considerably on the 10-year Treasury, and they're back up this week. So there's been a lot of comments with the ECB that just dropped their rates. So that's starting to think, well, maybe we're going to see something. We also heard the jobs reports came out on Friday. Obviously the government is trying to not lose too many jobs, and potentially if we drop the interest rates too soon, then we've got an inflationary issues continuing. So, it depends on who you talk to, but in my mind and what I'm seeing on the forward curve is pretty steady, not a huge drop over the next, let's say, 5 months or so. I think it's just we're gonna just kind of keep going along.
Yep,
Yeah.
that's exactly what we're hearing on our side too. So,
Yeah.
Yep, time for everyone to adjust. So
Yeah.
I don't think we're ever going back to 2-3% interest rates.
I don't think so.
Not anytime soon.
That's right.
Okay, So next, longer term renters. So given where interest rates are, we had a lot of home buyers in the market in 2020, 21, 22 that were home buyers because of how low interest rates were. And now we have a whole slew of the population who is no longer able to afford purchasing a home given where rates are. And so they're going to be longer term renters. So while all the changes in interest rates have certainly provided a challenge in terms of cost of capital, I think we're going to see that they're going to actually improve the fundamentals as we go forward, because a lot of that renter population is going to be stable as a rental population, and rental units are not going to be competing as heavily with for sale housing units. So the BTR product has been wildly popular over the last couple of years. I think we're going to continue to see that product type rise in popularity. I think we'll see it on the workforce side. I think we'll see higher end examples of it as well, kind of catering to the young professional kind of demographic set. So that will continue to be a very strong product type. And I think that we'll see, again, really strong fundamentals going forward, which will help make up for, some of the rise of cost and capital. Next, distressed deals. So we are beginning to see some distressed deals, and there are probably more distressed deals out there than we know about because everyone has sort of battened down the hatches and has been kind of holding steady for the past year and a half or so. But what is going to happen is we're going to start seeing some of these distressed deals. A lot of what we're seeing on the deals that are distressed right now are that they had some kind of fatal flaw in their business plan. So business plan is key in the environment that we're in. When we had really cheap capital available, there was a lot of margin of error for various things to kind of go awry or go wrong in a deal, and it be okay because the debt was cheap and there was still a lot of room for healthy returns on the equity side. But with the cost of capital higher, those margins of error are much thinner than they were when capital was very cheap. So having a really good business plan, I would say like discernment is key as kind of my my mantra of the year. Having a really strong business plan and really thinking things through, leaving some good room for contingencies in your business plan, making sure you've got healthy cash reserves, good liquidity as an investor, you're not over leveraging. All of those things are going to be more and more important in this kind of higher rate environment. And on that note, talking about distressed deals and where are they? Have we seen them? Are they out there? I think we're about to really find out, because what we do have coming towards us is sort of what a lot of folks in the business are calling the wall of maturities, meaning that there are a lot of loans, especially bridge loans, that were put into place in 20, 21, 22 that were on 3 to 5 year terms, some of them even on 2-year terms, that are going to be hitting maturity over the next year. And so what's going to happen, a lot of those bridge loans were extended. A lot of loans in general have been extended, but we are seeing a lot of lenders kind of getting to the end of their appetite for extensions. And so these maturities are going to now have to go to market, find new financing, and we're going to be finding out of all these deals that got bridge loans and executed value add plans in 20, 21, 22, how many of those are going well, and how many of those are a little bit distressed. And what I think would define distress would be if you're over leveraged, if you're not at break even. So right now, what I have been telling a lot of people is that break even is winning. So if you went into a value add deal in those early 2020 years, and are now looking to exit, and you've got a maturity, a break even is an absolute win. Meaning, if you are worth what you bought it for plus what you put into it, you did good. So, and I know that's sad because a lot of value add buyers were hoping for some great profit. I think that profit is coming. It's just going to mean a longer hold period in order to realize it. We've talked about all these great fundamentals. We talked about the rent growth that's coming. It is coming. You're just going to have to wait a little bit longer to realize your profit on that investment. So, again, I think lots of opportunities to come. As these maturities come, I think we're going to see deals that are distressed, and there might be some great opportunities if you're a savvy investor to get out there and find a good deal. If you've got some assets that have to refinance and it's not penciling, I think we'll start seeing a lot more things going to market. And finally, given all of these factors and really all 9 things that we've talked about up to this, I think vetting your sponsors is more important than ever. Having a strong business plan, having really experienced, savvy players on your team, people who've been through economic downturns, people who are financial experts, Julianne, cost segregation with Mark. I mean, doing all of those things that are really savvy ownership activities, appealing your taxes, those are all going to be so much more important than they were over the past several years, since that margin of error is so much thinner with cost of capital higher. So vet your sponsors, spend lots of time with them, ask them about the deals that they've done in the past. Ask them if they've ever had anything foreclosed and why. Really do your due diligence when you're vetting your sponsors, as I think that's going to be really important going forward.
All great topics. You could drill down on each of those items. Thank you so much for breaking that out and how you as an appraiser and your team are looking at things. The challenge is, where are we going? What's happening currently? What's the past look like? I do have a question for you. And with the great financial crisis that we went through in 2010, 2008, wherever you were, those years were a little differently looked at differently, but a lot of it was driven by appraisers, right? How do we value these properties? And the values we saw a lot of them got lost, right? And people lost money. They lost their homes. They lost the properties itself. Are we in, and have we put in a structure strong enough to allow these appraisals to get through the system accurately enough that we're not creating, or is it too stringent that we can't get these deals across the line?
Mm-hmm. I think that's a great question. It's a very thoughtful question. And I think that the important thing about the appraisal process is to have that independence. And I think where we've seen things go really awry in the appraisal process in the past, whether it be the recent past or back in 2007, 8, is when the appraisers do not have a good level of independence from the deal. And so I think that that's a really important factor. And then also just vetting, the quality of the appraisal that you are receiving. So that's what Freddie is really focused on right now, is ensuring that they've got very high quality appraisers. If you get an appraisal that's got sales in it that are more than 12 months old, that is not a very credible appraisal. So that topic of credibility is very, very important. Um, and to be fair to the appraisal side, we appraisers can only work with the data that we have. So in a period like this where we're, in a place of price discovery, every new transaction is telling us something new about the market. And so there is going to be, there are challenges in developing a credible appraisal report. So it's really important that you're using appraisers that are really in touch with the market, know all of the trades that have occurred, have really great relationships with the sales brokers in order to have great information about what's going on in the market and understand the buyer appetite for any particular asset type. Um, and have a deep level of expertise. You want to be using an appraiser that's specialized in a property type, and you want to be using an appraiser that has a good amount of experience. And I mean, I think that means really takes about 5 years in this business to have great experience. So you want to make sure that your appraiser has more than 5 years of experience and is specialized in your property type.
So let's take that down another road. When we're working on an appraisal for Fannie or Freddie, we as the buyers do not get to call up Aimee and say, Aimee, I want you on this deal. It seems like it goes to whoever either has the right price for it, availability. How, as a buyer, how do we vet that appraiser who's going to be, we're really putting so much of our energy and enthusiasm to getting the right appraisal done on our property?
Yeah, absolutely. I think you as a buyer and a borrower have a little bit more say than you might think with your seller servicer. So don't be afraid to request a firm, request an appraiser that you know is reputable in the industry. I think staying with the major national firms is definitely a great way to go. They all have appraisers who are specialized in their property type and are very experienced. So staying with those major kind of real estate firms, kind of the big three of commercial real estate, is a great place to start. But don't be afraid to ask your seller servicer. If you feel like an appraiser is particularly reputable, I think the key is to not ask for an appraiser because you feel like you had a great experience with them or you have a great relationship with them. Ask for them because of their credentials. That's kind of what's key right now.
Aimee, we talked earlier about in our conversation between the two of us about how sellers are really starting to reach out to you as an appraiser to get a level
Yes.
set on what is my expectation. I've done all of this. We're in a bridge loan. We're trying to figure out, can I get to agency? So kind of talk to us about that, how you're really even seeing it from the seller side as not just the buyer side.
Yes. In fact, we're starting to see a lot of brokers coming and partnering with us. In fact, we're doing several appraisals right now for various sellers via their brokerage group, just to get a good read on where the property value is. One, so that they have reasonable expectations when they go to market. And two, it really helps to be able to say to your buyers, hey, we've had a recent appraisal done, and that's how we came up with our offer price. This is not something that we came up with because it, checks some return box for us or it checks some break even box for us. This is what we had it appraised for. And there's a good chance you can have it appraised for that when you go to get your financing as well. We've had a lot of sponsors reach out just to do kind of value check-ins, and we've got a great product for that is not kind of the full lender scope appraisal. So if you'd like to do a value check-in with an appraiser, please feel free to reach out. We can often get those done, for anywhere between 1,500 to 2,500, which is about half what you would pay if you were, doing a full lender scope appraisal. But it'd be really nice to just know where you're at on asset value.
That's a great suggestion. All right, let's open it up and see if we have any quick questions. Angel had a question about going into stagflation. Let's see, where did that go? Here it is. What are your thoughts if we get into a stagflating economy? How will that affect the values, your appraisals, pricing?
As a stagnant economy.
Let's ask Angel. Angel,
Yeah.
So
what was your question?
stagflation. So basically what it means is zero GDP growth. So no production, no product growth, and inflation so high that we're just burning the candle at both ends. It just sucks, like late 70s, early 80s.
I gotcha. Yes. It depends. If we start seeing that get to a point where it's impacting household formations or purchasing power, to the point that we're seeing households begin to combine, that's when it's going to really start impacting multifamily. So, in terms of like consumer spending and things like that, there's not a lot of impact on housing. But when it gets to the point where people are making different housing decisions because of those factors, that's when we're going to start seeing an impact on multifamily performance and values.
Yeah. So the reason I ask is we're definitely seeing that. We're seeing household combine. We're seeing people skip and having to be evicted. And those are our class C's. Now our class B,
okay, yeah,
it's freaking 100% for the next 60 days. Like we are trending massive because your A's will go to a B, your B's will fight tooth and nail to not go to a C. And so we're running 100% there, but that class C, it's rough.
Yeah, and the eviction space is really rough in a lot of markets right now too. Even in Texas, which is a very owner-friendly environment, just getting through the court system is a real challenge these days. So we are seeing, because of this, we are seeing a lot higher levels of credit loss in the kind of B minus C space than we've seen historically. And I think that is one of the early indicators that we're about to see, major household reduction in that space. But yeah, you're right. I mean, when inflation becomes such an issue that it's impacting consumer spending, people will cut back on what they'll spend on their housing.
Yep.
But
Makes sense. All right.
Yeah.
Anybody else have a question? This is your opportunity. Live conversation with our industry expert, Aimee from Colliers. Anybody? All right. Well, Aimee, you've covered a ton of information. If somebody wanted to use you or have a conversation, how would they reach out to you?
Yeah, absolutely. Please feel free to reach out. I put my contact info in the chat, and you can always reach me through Julie. Great way to get to me. And if you Google my name, I will come up. If you Google Aimee Nicotra Colliers, I will come up and you will find my information on the Colliers website. So please feel free to reach out if you have questions about anything appraisal related. Please reach out. Please feel free to give my name to your lenders and just say, hey, this is somebody I heard speak. She's very knowledgeable. She has a lot of experience. We'd love to at least see her on the bid list. That's always a great way to put it. rather than demanding. Just say, hey, would really love to see this person on the bid list.
Great suggestion. And for those that are watching this after the live conversation, Aimee with Colliers can be reached out at a direct phone number of 972-998-3923. So again, feel free to reach out to her or reach out to me. We can have a conversation, the three of us, jump on a call. I think it's really worth your time and energy to engage an appraiser, to get a sense of what is realistic? Where are we seeing the values? Where do we see the taxes? Where do we see payroll? All of the line items in the expenses are truly affecting these deals. And where we're seeing some of the challenges, not only in the expenses, but also on the revenue side. Where are the rents going and what can we anticipate seeing from the comps in this area? So Aimee is just a wealth of knowledge and she can be so supportive to your business. So thank you again, Aimee.